Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. And yes, it's finally happened. Bill Ackman's Pershing Square Holdings, the biggest SPAC out there, is taking Universal Music Group, the publisher of such hits as Rick Astley's Never Gonna Give You Up, public via a really complicated transaction that we'll take a look at. And I also want to take a look at the valuation we're getting here as investors. I am an investor in PSTH. On the face of things, I really like the deal. I've talked in other videos how I like the music industry. There is another SPAC video that I'll link to down below where I kind of went into detail about the music industry, why I like it, why I think it's good. Honestly, I think there's value in music royalties and value in music catalogs beyond what we're getting now. If you look at TV shows like Friends, they're selling the rights to their show for 5 years for 500 million plus, not even perpetual rights. However, music catalogs for people like Bob Dylan, UMG bought that recently, are selling for less than that for the entire catalog for the life of the rights. And with the advent of streaming, you're talking about perpetual revenue for these companies because music isn't going anywhere, and the streaming share that companies like Apple Music and Spotify are giving to companies like Universal Music Group or Warner Music Group or Sony are really, really pretty decent. So this is a pretty high margin business. Whether you're publishing, whether you're a recording studio, UMG is a bunch of that combined. They also sell, stuff like T-shirts, etc. at concerts. So they have a lot of hands in the cookie jar when it comes to music, and all of that is very valuable as the world opens up for the pandemic and concerts become a bigger and bigger thing, because UMG will make a little bit of money off of that, but mainly because they own the rights to so much good music. The Beatles, others. There's a list you can find, but they've got the Beatles, they've got Pink Floyd, they've got freaking, I think Taylor Swift. Personally, don't listen to her, but she's very popular, or so I hear, etc. So every time somebody streams that song on Spotify, every time somebody streams a song of theirs on Apple Music, anytime somebody buys one of their songs on Apple Music, do people still buy songs? Anytime somebody buys a CD or whatever, a cassette tape, whatever people are buying these days, vinyl came back, maybe cassette tapes are back. UMG is getting a cut of that pie, and that's a pretty good business to be in, considering that music is part of our lives, it isn't going anywhere. The interesting thing about this deal is it's structured in a really weird way. I'll go into that really quickly before we dive into the details. I don't want to make this a 35-minute video. So if you're a shareholder of PSTH, three things happen. And this is oddly structured. First, and the important thing to know, is that PSTH had about $4 billion in money to spend, plus an additional $1 to $1.5 billion that PSTH was throwing in themselves to put more of their skin in the game. They're not using all of that money to acquire UMG shares. They're using part of that. So that's one thing to remember. Secondly, is that they're not actually buying the entirety of UMG. They are buying 10% of UMG at a valuation of about $35 billion. And then later this year, when Vivendi, the company that currently owns UMG, lists UMG on the Euronext stock exchange in Amsterdam, PSTH shareholders will get UMG shares from PSTH. So this is a bit interesting. This is going to be shares that are traded outside of the United States. I don't know how that works. I don't actually own any shares that are traded outside of the United States. So leave a comment down below if you know if there's any tax implications of this, if there's any issues with it. Kind of bums me out because there's a bit of a, it's just easier for people to buy stocks on the New York Stock Exchange or on the NASDAQ. One thing I look forward to in the future is that potentially there's an uplisting for UMG that will further drive some value in the future. If they say, hey, we're listed on the Euronext, but we want to also IPO on the New York Stock Exchange, why not? Why not do it? Raise some additional money. A stock price might go up. The amount of people that'll be buying your shares, because there's just more of a market for shares on the New York Stock Exchange or the NASDAQ, might go up. So this kind of lays out the details of what's going on. Minimal financial leverage, which is good to see. A pure play major music content company, the number one market share. They own about 30 to 35% of the market share in the music space. That's huge. Really good to have scale in this industry and to be the number one person to work with. It is irreplaceable IP. It just is. Predictable recurring revenue streams. Totally agree. I like the music industry for a lot of these same factors. And I talked about that in another video, like I mentioned before. So that is the deal. The interesting thing about the deal is, one, you get the shares. Secondly, there's money left over. So there's about $5.25 out of the $20 that were originally in the SPAC. That is going to be traded on the stock exchange and give Pershing Square another 1.5 billion-ish to work with to acquire another company. So there's potential to get another company out of your PSTH shares. You're getting the shares of UMG that are going to be traded on Euronext. Then you're getting a RemainCo share, which is going to be about $5.25 in cash per share, that they can utilize to acquire another company. So that's yet another company. This is no longer a SPAC, but it gives you the upside of potentially something else happening. And the good thing, just like with PSTH, Pershing Square is potentially throwing in another $1.4 billion into the deal to fund a future business transaction. So that tells to me that, hey, maybe we have something cooking already. As a PSTH shareholder, I'm like, hey, I'm getting UMG. Seems pretty decent. Then I'm getting this RemainCo, which might be something. Who knows what it'll be? Clearly a smaller company, because we're talking about 1.4 to 2.9 billion versus 4 billion invested here. And that's kind of interesting. That's kind of great. But the butter on the bread is that you also get another thing, which is a spark, which is the right to purchase another holding, a future holding that will collect 5.6 billion in cash, with Pershing Square having an opportunity to throw in another 1 to 5 billion at net asset value at $20. So what this is essentially doing is it's rewarding the people who own PSTH up until business transaction and giving you the opportunity to basically buy their second SPAC at $20. Bill Ackman made a tweet that said, hey, we're going to reward shareholders of PSTH who stick with us. And he's doing that through this. So you're getting three things here. You're getting a share of UMG when it lists on the Euronext. You're getting a RemainCo that's going to trade at about $5.25 and is going to acquire something with the 1.4 to 2.9 billion in cash that they have. And there you're getting the rights to purchase a future company at $20 whenever that happens. This has a term of 5 years, so this could be forever from now. But when you think about, hey, 5.6 billion plus up to 5 billion, that's up to 10.6 billion in this business combination. That opens the door to a lot of big companies. There was talk of this being Stripe. Is this more in the Stripe price range at this point? Stripe, Plaid, whatever. This didn't turn out to be what people wanted, but there's certainly a lot of moving parts in the deal that allow more business combinations to happen. And I really like the way this is structured, because it seems to be structured in a way that benefits the individual shareholder. If you've been holding PSTH for, whatever, months and months and months waiting for the deal, and you bought it at $21, which is where I bought it right off the bat. I was like, hey, I trust in Bill Ackman. This is a good reward. I get UMG, which we'll see if it's fairly valued in a second. I get this RemainCo that allows them to buy something up to, potentially 20 to 30 billion if they utilize their 1.4 billion of extra funds. So that's a sizable company. Hey, maybe we're going after Impossible Foods. Maybe we're going after something else that's pretty decent in that 10 to 30 billion price range. Who knows? There's certainly a lot of opportunities there. Certainly a lot of SPACs competing with Pershing Square, but a lot of opportunities as well. And then you get the spark, which, hey, you're getting something for $20. You don't know what that is, but there's probably no real risk in holding this because you're just getting it for free. And if you want to exercise it whenever they make a deal, whether it's 3 years from now, a year from now, 5 years from now, or 2 weeks from now, you can do that at $20, which is very, very friendly to investors. They're not giving these SPACs to hedge funds to buy right away. They're giving it to the people who are holding PSTH. They're giving it to an individual investor like myself, and that's pretty cool. So I have to read more into the details as to how this works. There's a bunch of weird stuff happening with warrants because, again, this isn't a real merger, so you can't have the rights to buy unlimited shares of UMG because they're just kind of selling them 10% of their company and listing more. So they're probably still working some of that out with Vivendi. But really cool deal, really interesting setup for investors. It'll be interesting to see what happens to the RemainCo. It'll be interesting to see how Spark goes. But hey, Bill really knows what he's doing. PSTH really was like one of the most popular SPACs. Like, what's it going to be? What's it going to be? And not only has he delivered something, but now there's two what's it going to be mystery boxes out there. Wow, how exciting. That's the beauty of being a SPAC investor. So how does the market like it? Well, they hated it initially. The market really sent us down to 21.77. I kind of wish I was home then to buy more stuff after hours, but I wasn't. I was at Costco buying coconut water. So, such is life. It ticked up a bit, and then the morning market hasn't opened yet, or maybe it has, but pre-market it's at 23.40, a bit down. WMG, which is the competitor we're going to compare it to, is at 36.33 pre-market, so going up a bit. Probably saying, hey, maybe this deal overvalues it a little bit, and Warner Music Group is a bit undervalued. And also, even if that's not the case, people are seeing that, hey, Bill Ackman's interested in the music business. Maybe there's something to it. Maybe Warner Music Group will go up. And there's another SPAC that I own, ROCC, which is taking Reservoir Records public. That's the video I talked about before. I wonder if they'll have any uptick because of this as well. There's clearly interest in the music industry, and it's proven by this. So I went through some of the financial statements, the annual reports of UMG and Vivendi. Vivendi actually does a pretty good job of breaking this stuff out, so you can get individual business data and get an idea of what we're actually getting as PSTH shareholders. So here is the gist. I put WMG on the left here. We've got their revenue from 2016 up to 2020. We've got their EBITDA from 2019 and 2020. And they're basically, at their last night's price, they're selling for about 4.6 enterprise value over revenue, 25-ish enterprise value over EBITDA. They have a little bit of debt. Their leverage is a bit higher than UMG. The letter before mentioned UMG at 1x. This is more 3.5x, so more leveraged. Growth seems to be slightly slower, but decent valuation here in relation to the market for what you're getting and the business that they're in. If we look at their pre-market price at 36.33, it's about 5% higher than it is now. This becomes more of a 4.826 valuation, but we'll leave that for now. So looking through the UMG financials, I was able to pull some of this information to compare. First thing to look at, what are the growth rates that we're seeing for this company? 18%, 3% for UMG versus 11% flat for 2020 for Warner. So UMG, despite being a larger player in the space, is growing at a faster rate. They did sign a new deal with Spotify, I believe towards the latter part of 2020, extending their relationship. One other thing to kind of keep in mind is I believe UMG actually owns about 3.5% of Spotify, but so does Warner. I believe a lot of the major labels own Spotify as part of the distribution deals and licensing deals they've signed. So at today's prices, that's about 1 to 1.5 billion in value. I believe they have to share some of that with the artists that they have signed as part of the deal that they signed with the artists. So that's one thing to keep in mind, but there is a little bit of upside with the Spotify holdings that UMG still has, and I'm assuming some of that will transfer over to the ownership rights that we have, because Vivendi probably won't keep that. They'll spin it off with UMG, hopefully. So faster growth on the UMG side. As far as EBITDA goes, 18% here, 13% here, faster growth here as well. EBITDA margins, another thing to kind of take a look at, 15% expanding to 17.9%, potentially part of the new deal, 16.4% expanding to about 18.7%. Seems like margins in this industry are growing, so that's a good thing to see. You want to see growing margins, growing revenue. Quarter one earnings already came out for 2021. Quarter over quarter, Warner was up about 15%, UMG was up about 9%, so good growth for both. Year over year and quarter over quarter. I mean, obviously 3% and flat in 2020 isn't great, but again, they make some of their money through tours and selling merchandising. So it's no wonder that merchandising sales were down when people aren't touring, when the pandemic is happening. However, streaming probably offset that to some degree, and streaming is becoming a bigger and bigger and bigger piece of their pie, and it's going to continue to get bigger as streaming expands worldwide. So overall, comparably, I think UMG is a better company than WMG based on some of these factors. Higher growth rates on both EBITDA and revenue, bigger scale. It's about double the size already in terms of the amount of market share they have. Valuation is about double as well, so kind of makes sense there. Valuation here, this is all converted from the euros that were in the announcement, 35 billion euro into USD at 42.3-ish billion is the EV value. I don't know the details of the debt, the cash, the market cap, whatever. That doesn't really matter. EV is what matters. So I kind of want to see, well, if this is at 4.6, what's UMG at 20? It's 4.7. It's 26. At today's price, like we saw before, it was closer to, this. So basically, the UMG deal at 20 is pretty good. It's pretty good. It's in line with Warner Music Group, which I think is a worse company. They have less artists signed, potentially a worse stable of artists. Margins are a bit higher, but their growth rates are smaller, and UMG is certainly catching up on the margin side. And having a growth rate that's bigger when your revenue is almost double is pretty impressive. So I think there's certainly some argument to be made for the idea that UMG should have a higher valuation. At 20, at the price point that deal is made, the valuation is basically in line. However, you have to remember PSTH is trading at 23.40 after hours. It was trading at 25 before. So let's say it goes back up to 25. Let's be optimistic here. At 25, the valuation goes up a bit, right? You're talking about 4.9 versus 5.8. You're talking about 26 versus 32. One thing to remember is that, hey, future EBITDA here, the growth is better. So you're paying for that growth. Clearly, we don't have a good idea of what this is going to be, but let's say it's 1.10 over here and 1.15 over here because the difference is about 5%. You're starting to get to a point where future EBITDA goes to 23, goes to 28. UMG is still at a higher price point, but it's closer. If we look at where it is today, pre-market, you're talking about 30 versus 26, 26 future versus 23 future. I think if I look at this, it's a reasonable valuation. I don't think this is a slam dunk by any means, but it's certainly a very reasonable valuation. And if Bill Ackman can get involved in what UMG is doing and continue to improve the EBITDA margins that we're seeing and spur growth in some way, then this could be a pretty good valuation in the long run, right? You're buying a business that is growing, that is profitable already, that is cash flow generating, that doesn't have a lot of debt, which gives it the ability to essentially, hey, we're going to acquire some more catalogs. We're going to expand. The things I look at when I look at the music business is there's opportunities. This thing is so fragmented in so many ways where UMG doesn't take advantage of all the things it could take advantage of. And it's the same thing for WMG. It's the same thing for everybody else. And the blockchain is the perfect example of that, right? And this may sound silly, but hey, NFTs are a thing now, and I'm not just talking about collectibles, which they can certainly make money on, but what about like an internal system where you can buy, sell, and trade tickets to UMG artists that is fully managed by UMG, that is held on the blockchain, that is cheaper than all of these other things that take a 20 to 30% cut. You never have to go to the Ticketmaster again. You go through the UMG. Sure, they make some money off of you. They charge you a higher price, but there's a built-in trading platform that UMG manages, and it's traceable because it's on the blockchain. It's kind of foolproof because it's on the blockchain. Your tickets will be what they are because you're buying directly from the source, and it's on the blockchain, and all of the details are trackable, and that's something, right? I think there's a lot of opportunity here. I think there's a lot of opportunity to make more money. If you look at UMG and what they're doing, hey, there's so many places you can make deals with these days. Peloton uses music. Let's charge them money for the music of ours that they're using. We certainly have a lot of music. They're certainly doing that now. But as that stuff becomes more and more popular, and this stuff, the stuff being music, becomes more and more ingrained in society, not that it isn't already. Can you imagine movies without music? Can you imagine your life without music? You certainly can't. And as more and more people join the fray, and more people in countries outside of the US and Europe and and other countries that already have Spotify jump onto the Spotify train or jump onto the train of other streaming services, all of whom pay some sort of royalty to UMG, which, UMG keeps some of it and passes it on to artists for another part of it. But this is a gravy train. There was an interview that said, hey, we're buying a business that could last even if the stock market shut down for 10 years. And this is totally this, right? The stock market could shut down tomorrow for 10 days and hey, Bloomberg would go out of business. Bloomberg was another transaction that was rumored to be for PSTH, which, hey, maybe it could still happen. Who knows? PSTH2 and the other one are still around. What a deal. And then music wouldn't go anywhere. Like, people would still listen to music. UMG would still keep getting royalties. Not that the stock market's going to shut down. That's a silly exercise. But this is a great business model. This is one I love. And I think catalogs are going to become more and more and more valuable because it's one of the few sources of revenue that is reoccurring and essentially guaranteed almost. People aren't going to stop listening to music, and also doesn't require any upkeep. Once you own a Beatles catalog, you don't really need to do anything with it. It's already created. It's already made. You own it. You're getting money every time somebody plays a song. That's why there's funds like the Gnosis Fund that are just buying up catalogs. That is a bit of a problem for companies like UMG. Certainly they're going to have more competitive a competitive landscape because catalogs are becoming more and more valued. They might have to pay more than they've paid in the past for certain catalogs. There's an emerging indie space where people can just publish directly to Spotify, or they can publish directly to Apple Music, not give UMG a cut. That's certainly a problem for UMG if that becomes a bigger and bigger piece of the pie. It's certainly a lot easier to self-publish your own stuff than it used to be in the past. So there are certain things that UMG will have to work around, but I think there's a ton of opportunities, especially in this new world where everything is digital. And this is, streaming, this is the blockchain and how they can utilize it. This is collectibles. Things are becoming more and more digital. And as things become more digital, the assets that you have that are digital in nature become more and more valuable because they're cheap to maintain once they're created, and they're essentially perpetual revenue, right? You talk about a perpetual money machine, UMG is something like that. WMG is something like that. All of these music businesses are something like that. And are they paying a premium for it? It's hard to tell because we don't know the details yet, but it seems like, to me, UMG is best of breed in terms of what they have. They're getting to be as good as the others, or best of breed in terms of their margins. They're best of breed in revenue already. Their number one market share, and scale is important here. And yeah, you're paying a bit more than you might for WMG, but you're getting more. You're getting Bill Ackman, for one, as well, who will get in there with whoever he helps, he works with at that company to help the company grow. He's done that time and time again with other companies. Now, maybe he doesn't have a lot of experience in the music space right now, but he's certainly working with people who do. And I think the value creation here is going to put this beyond where WMG can go on their own. But also, they already own assets that are better than WMG. So I have no issue paying a bit more than WMG for this. And this isn't a lot more, right? This isn't an outrageous valuation for what you're getting. And as a PSTH shareholder, you get this, you get PSTH RemainCo, and then you get this Spark thing, which is the ability to buy something in the future. And some of that, the value of that is a question. Those two deals could suck for all we know. And maybe I don't want to buy something that sucks for $20. So what do I care about these rights? However, he's got a pretty decent track record. And the good thing about the SPAC, and this SPAC in particular, is that there isn't a lot of dilution, right? They're not really taking the company public. They're just buying 10% of it. The way the SPAC was set up, there wasn't a lot of dilution. There wasn't a lot of sponsor shares. The sponsor shares were much lower than the average SPAC. It'll be interesting to see what happens to the cash that UMG gets, Vivendi rather gets. Are they going to put some of that into UMG when they take it public? Are they going to take all of it themselves? Will UMG have a little bit of a cash hoard to spend money on? And then another thing to remember, hey, Vivendi is still a company that trades. If we look at the Vivendi market cap, I want to say it's somewhere in the 40 500 billion range. They have about 4,500 in debt, I think. So this is just off the top of my head math. They own 80% of UMG, right? Right now, UMG, which has an enterprise value of about 49 billion, you're getting Vivendi for 47 billion, and 80% of 49 billion is 39 billion. So you get the rest of the business for 7 billion. And the rest of their business is okay. So for example, UMG makes up about 45% of their revenue, maybe about 70% of their EBITDA. But is Vivendi a way to play this as well if you're not an owner of PSTH and don't really care about the other stuff? I think so. So I don't know, man. I kind of like this deal. I like the music industry. That's why I like the deal. I think there's a ton of opportunity for disruption there. I think the blockchain is a good option for companies like UMG to really change the way the game is played and make a boatload of money while doing it. I think ticketing, collectibles, music releases on the blockchain, they're all going to happen. It's just a matter of when and who does it. And I think if UMG can take advantage of that, they have a stable of artists that are going to keep producing stuff. They are the home to some of the newest, most on-brand artists as well. Taylor Swift, Billie Eilish, Post Malone, all those dudes, all those people or ladies that I don't listen to, but they're popular. So certainly there's something attractive about UMG, and they are continuing to sign high-profile quality artists. And the valuation is pretty good. You get Bill Ackman on top of it. You get this weird deal structure where not only you get UMG, which is traded on the Euronext, which might be a bit weird for tax reasons, but you also get PSTH RemainCo, which is going to buy some other company with 1.5 to 2.9 billion in dollars. And then you've got this Spark, which is the opportunity to buy at NAV at $20 a company that might be in the 5 to 10.6 billion range in terms of the amount of money spent. So you're talking about 50 to 100 billion valuations for that second company, 10 to 30 billion valuations for that first company. Pretty interesting deal. UMG isn't what anybody really wanted. There's a lot of like, well, this sucks. Why do I want this? But I think it's pretty good. I like the industry. I am going to hold this long term. There is a lockup period. I think Bill has like a 3-year lockup period, so certainly he's not getting in and out here. He's a long-term holder. I think he's going to be involved in the company, and Pershing's going to be involved in the company. And clearly, they're using some of their funds to buy it beyond their sponsor shares as well, because the fund itself was $4 billion, and there's still $1.5 billion left after a $4.1 billion deal to fund RemainCo. So not all of this is just user funds. It's also Pershing funds, so they have skin in the game without harming the investor. So overall, pretty good. Just wanted to do a quick video about what I think about this deal and how it's structured. It's an interesting one, that's for sure. Let me know what you guys think about the deal. If you like it, if you hate it, if you're excited about the RemainCo, the rights dealio. I think it's going to be a cool couple of years to be a PSTH investor, and we'll see what comes of it. Again, this isn't going to shoot to the moon in a week like people want, but you're getting a revenue generating company with 18% EBITDA margins for 40 some odd billion EV. There's been articles that have valued this anywhere from 35 to 120 billion because of the strength of its catalog. Who the hell knows? I think there's more value in assets than just the strength of its revenue generation, right? There's a reason stuff like art sells for a boatload of money, and this is art. You're buying art that just happens to generate a ton of revenue, but could have value beyond that, intrinsic value beyond that might not be represented in the stock price of any of these assets. And I think that's true. I think that's totally true. And what could bring out that intrinsic value is, NFTs, blockchain, etc. And that's the upside here. But even without that upside, this is still a good compounding, 8 to 10, 12% compounder year over year. They're probably going to buy back shares, cash flow generations out there, maybe issue a dividend in the future. And then you've got other stuff going on with PSTH if you continue holding. Overall, pretty happy. Can't complain. Like the music biz. Plus, it's got Vanessa Carlton's 1,000 Miles, a seminal classic that you should listen to on replay. And if you do own shares of PSTH, just look up their artists, listen to them over and over. Every time you listen to them, you get a millionth of a cent in your bank account in the future in the form of earnings. So, hey, it's a good business to be in. All right, guys, thanks for watching. Hope you enjoyed the video. Leave a comment down below. Let me know what you think about the deal. Remember, I am not a qualified financial advisor. Please talk to a qualified financial advisor before making any investment decisions. I am not one of those dudes. Thanks for watching and have a good rest of your day.